Okay, thanks everyone. We got a quick 15-minute session, so I'm going to get straight on with this. We're going to be talking about the art of fundraising and how do you, when you've got your startup with your fabulous new idea, how do you actually get the money to go and fulfill that? So just like my panelists to quickly introduce themselves, and then we'll get on with the chat.
Sure, okay, so my name is Michael Wilkinson. I'm the head of equity at Crowdcube. In essence, we're an equity crowdfunding platform. Retail, very good vertical for us, but myself as well, I've been with Crowdcube now for 4 years. So my other angle, as well as the crowdfunding, the equity investment, is I've been on this journey, the startup and early stage journey. So I've got both angles that I'll be able to bring to this discussion.
Hi, I'm Daniel. I'm one of the partners at Balderton Capital. We're a very early stage venture fund based in London, investing all over Europe. We've invested about $2.4 billion in our life in startups around the continent. And we'd like to kind of get in relatively early, Series A, write $5-6 million checks, and then go on the adventure with the companies that we back.
Hi everyone, I'm Paul Cocker. I'm co-founder of True Start and True Capital, so partly responsible for some of what's going on today. We haven't quite invested $2.4 billion yet, but we're on that journey.
My name's Edward. I'm the founder of Love Crafts. Full disclosure, these two gentlemen to my right are both investors. We've been going about 3 years. We've done a seed round, a Series A with Balderton, and a Series B last summer with Highland Capital. We're in the early part of our Series C, which we will expect to close Q1 next year.
Fantastic. Okay, Daniel, we're going to start with you. So going right to the start of the process, when you first see a pitch or a deck of a startup, what attracts you to it? What makes you think, wow, I must invest in that? What kind of things do you look for?
That's the colour scheme. It's always important. No, it's not. Look, I think we get drawn a lot by two or three things. We get drawn a lot by the ambition and the vision and the story the companies come and tell us, and hopefully they're trying to make a major impact in some particular area of the world, and it's an area where they're going to be able to achieve a great deal. And we get incredibly drawn into the personalities of the people we're sitting talking to. At the end of the day, we back people, and it takes a very special person to go on a journey from 5 people to 5,000 in a company. So we spend a lot of time thinking about that.
And Paul, what are your views? What gets you excited?
Yeah, I think, well, because the private equity side of the business as well at True Capital, we do a lot of our own research about the types of companies that we want to be exposed to, the sectors that we're interested in, demographic change, that kind of stuff. So we'll look to see if the company fits within that thesis. And then when it actually gets to the specifics of the company, it's a bit of a cliche, but it's predominantly about the team. So I think it's easy to say, what is the team? It's actually someone who's got an ability to sell a vision. Someone you've got to take a lot of people on a journey if you're going to build a company. And so that's the first thing we look for. And secondly, like Daniel says, it's got to be a product or a market that they've got some traction in, and a product that's very differentiated.
And Michael, when you're looking at it from a crowdfunding perspective, are you looking at the same kind of things in evaluating what kind of pitches or what kind of companies, startups you think are going to succeed?
Actually not too dissimilar at all. Remember though that we're a marketplace, so we don't curate nearly as much as either of these two guys. What is really important for us though are kind of 3 key areas. In addition to what you guys have said there, a founding team, a strong entrepreneur, but equally an idea, and this is relevant particularly to crowdfunding, that can create some format of engagement, be that emotional engagement, practical engagement, socially responsible engagement. That type of thing is really important. And finally, just like the rest of the investors here on this panel, it's really important to have a market that is large enough to generate a sufficient return. At the end of the day, people investing in equity crowdfunding pitches are still playing the high risk, high reward strategy, knowing that the majority of their investments aren't actually going to make them a huge amount.
And turning to you, Ed, as a founder who's been through a few funding rounds and raised a significant amount of capital for the business, can you talk to us a bit about your first experiences and how much of a steep learning curve it was when you set off on the trail?
Well, I've been through fundraising a couple of times now for different companies, so this time we were a bit more experienced. I mean, I feel like everything in the world today, the availability of data has transformed a lot of different activities, and so as a founder, you can do a lot of desk research, right? So you can understand where companies are playing, which sectors they're playing in, which stage they're playing at, what's the deal flow they've been looking at. And you can make pretty sensible guesses about who you want to talk to. And having said all that, I think that personal relationships end up being quite important. So the power of an introduction, for me, is still extraordinary in this day and age. And typically, I think all of our investors have come through those personal connections.
So you clearly say that it's important to focus on the types of investors that you're working with and the looking at that partnership approach to the business?
Yeah, I mean, I think people often mistake a funding round for a transaction, like it's speed dating or something. And actually what you're doing is you're going through a courtship for some pretty ugly long marriages, right? So you've got to be pretty sure that you pick the right partners because they're around the table with you for a number of years, it's important.
Absolutely. So, I mean, the theme of today is around B2C companies. And we heard Mike Jones earlier talking about a few metrics that he now looks for, sort of, if it's not above 50% gross profit, he won't invest. So, and things like that. Daniel, are there specific things in B2C businesses that you would look for or that will make you either invest or things you'd see that would make you not invest?
Yeah, look, I think it's hard to have a hard and fast rule for every company because we take a very broad perspective on all sorts of enterprise software to consumer to marketplaces to gaming. We do try and understand the fundamental economics of a business, and does that make sense? Or if it doesn't make sense now, is there enough evidence that it's going to make sense soon as the business gets to a different scale? So of course that's important. I think there's some things that turn you off easily. I mean, if we have so many pitches that are done badly in terms of people who maybe spend half an hour talking about the market opportunity and the competitive landscape and 5 minutes talking about their own business. It kind of gives you a hint that maybe they're not the right person because they can't even tell their story very well. So yeah, I think there are a couple of points.
On that point, Paul, what common mistakes do you see in pitches and presentations and decks that you'd maybe offer some advice for people to focus on when they're doing that early stage funding round?
So I think because the first thing we're looking for is a team, I think it's really important when you're doing a pitch to make sure that personality comes across. So as Daniel says, to talk about the company over and above talking about the market opportunity, I think is really important. It needs to come across to us that a founder and entrepreneur understands how business is going to scale. And if that can't come across in the meeting or in the pitch deck, then I think that's something that's pretty difficult to overcome.
Michael, coming back to you, with crowdfunding, how does that fit alongside more traditional forms of capital? What are the sort of the pros and cons of using the crowd versus the more traditional forms?
Sure. It's a good question. It's interesting because over the last couple of years, in particular, crowdfunding has shifted from this very kind of alternative, a second best option, to something that is becoming more and more mainstream. If you look at the number of seed deals done in crowdfunding in the UK last year, it was about 230. I think through venture capital and private equity that they did about 116, 118. So there's a significant change in the opportunity for some of those entrepreneurs. Now, to answer your question, I think they fit alongside a lot of these partners, particularly the venture capital companies. Fits very well with crowdfunding, and we see guys like Boulderton, MMC, Index investing either as a lead in a particular round on Crowdcube, or as a support in the background. So more and more we're seeing collaboration of various different funding models through what I suppose is a kind of investment hub, a crowdfunding investment hub. As to the pros and cons, so I suppose to start with some of the challenges, it's a very public method of raising finance. You're putting yourself out there in front of thousands, potentially millions of people, and that highlights the challenge with a prospective public failure. If you can get over that, and if you can prepare your raise, give yourself the best opportunity, then you can work with that. On the other side of the coin, from an upside, you have this magnificent marketing effect. And it's fantastic for retail and consumer-based businesses to enhance traction, sales, users, all of these really key metrics that you'll need early on in your business. So yeah, it does differ to some of the models, but there are upsides to doing it.
Absolutely. And Edward, coming back to you, being honest, how much focus does it take away from the business when you're in fundraising mode, and how difficult is it to keep that focus? And have you got any advice on how to do so?
I mean, I think sole founders struggle. In my perspective, if you've got a capital-intensive business and you need to go out for significant rounds of funding, you are leaving your business for long periods. And so I feel very lucky. I've got 2 co-founders, one of whom leans on the investment process, and she will bring us in towards the end to get involved then. So we're lucky. So it does take someone out for a significant part of the business. I feel like we should think about that in the way that you time your rounds, the amount of capital you raise. You don't want to be doing it, every 6-9 months. We try to get 2 years runway out of every deal we do. Sometimes we don't quite manage it. But that's the intention anyway.
And Daniel and Paul, would you echo that in terms of sort of how would you advise your management teams on sort of timing of fundraisers? How much they should raise? Should they raise too much? Not enough? I mean, what?
Look, I think it takes a huge amount of oxygen out of the room for a team, and you lose 3 months of being kind of full on pedal to the metal execution. That's just the reality. It's hard work. I mean, the best companies we work with, it takes them 3 to 6 months to raise a good round of financing, and they meet 20 or 30 investors. They have multiple meetings with each one, and then they go through a diligence process. It's just a huge effort. So I think there's 2 bits of advice we would give them. One is plan for that, and plan plenty of lead time when you go fundraising. Don't leave it. We've got 2 months of cash. Now it's time to go out. And 2, as Edward said, you've got to build enough runway for the next period of operational execution before you're doing that again. And 18 months is a minimum in my view. If you're raising less than that, you're basically going to be executing for 6 months and then starting again. Yeah.
I think the key is to make sure the process is really well planned, and the other thing I'd add to that is to make sure that you leverage the experience of your existing investors as well if you're in that position, and utilise the networks that they've got, so you can try and organise a process that can get momentum into it. So as far as it is possible to try and work to deadlines.
And a question to all of you, does your thinking change in terms of your business or your investment criteria or thesis as to whether we stay in the EU? Who's taking that one?
I don't think it makes it, it's not something we think a lot about. We invest in businesses which, in the majority of cases, are global from day one. They're operating in a global marketplace. And so, corridors of trade are not that important for them. Now, I think there will be, there's potential issues with recruiting and getting good people into the country, which there are issues with now, which we worry about, and the teams we worry about. But from a commercial point of view, I don't think it's a major problem for a lot of the companies we're involved with.
I mean, we have 20 nationalities in the company. There's just under 100. And the uncertainty that would give a significant amount of our staff would be a problem. But other than that, we don't really think about it.
I think from our point of view, it may have an impact. So please all vote to stay. We see investment currently from all across Europe. We have a UK prospectus limit of about 5 million euros. And it can go one way or the other at the minute. We're spending a lot of time with the EU talking about the prospectus directive and the possibility that might be able to go up to circa 20 million euros, which would be fantastic for our particular model. Were we to exit Europe, I think the barriers to that investment across borders would be a challenge for us.
Absolutely. Okay, we've got just under 1 minute left. As a final question to all of you, maybe starting with you, Edward. If you were able to give a young management team one piece of advice as they set off on the road to raise equity, what would that be?
Good question. Be thoughtful about who you approach and focus on the quality conversations.
Perfect. Paul?
I think it would be an appreciation of how hard it is, and to recognise that there's a lot of smart people who'll probably say no, and that doesn't mean that you haven't got a great vision.
I would kind of echo something Edward said earlier. Make sure you find someone who wants to fall in love with you before you ask them to get married.
I think from my point of view, it's actually do something you're truly passionate about. when you're out there pitching to investors, writing your investment memorandums, you're going to be spending a lot of hours drinking coffee and burning the candle at both ends, and you need to really believe in what you're doing in order to make that work and be successful.
Excellent. And on that note, I'd like to thank the panelists. I think it's been a great discussion. So if we could just say thanks.